Okay, so good morning, everyone. Welcome to the macro snapshot for today, which is Tuesday, November the 28th, 2023. Okay, so we had a sort of a pretty quiet day yesterday. And one of the, we can see that reflected in something like the VIX. So we see the VIX, first of all, is at very, very low levels, just between the 12 and 13 handle. So again, I repeat, anyone who wants to sort of be hedging a sort of a portfolio or maybe going along a directional trade or long gamma, this is a pretty good moment. But it's not only in the VIX, we also see in the MOVE index, which is the volatility index for the bonds, of course, that's just keeps on grinding lower. So the thing is, what that's indicating to me is that there's low volatility in bonds. The bond market is relatively happy with what's going on. And if the bond market is happy and yields, that's going to, essentially create less stress in other parts of the market. And we can see that, let's say, if we go into the ES here, we see that for the last 3 or 4 days, we're having a bunch of sort of inside days. And, a lot of that was to do with sort of Thanksgiving and low liquidity and just sort of a lack of market energy. But also there's just like a lack of sort of very important sort of a data points and direction in terms of monetary policy. And at this point, we seem to be stuck in a bit of a zone where, anyone who wanted to be long really hopefully had got long at this point. Anyone who missed it, at this point, you're buying at highs and the risk reward is sort of horrible. On the other hand, in terms of shorting, yes, you could say that this is, from a technical perspective, an interesting level. And the risk reward here is pretty clear. Your risk is defined. But could this grind up higher? Absolutely, because at this point, we have yields going down. We have a market which basically believes that the Fed is done cutting. So at this point, it's a bit tricky to see, what's going to be the huge catalyst to push hard upwards and also to push hard downwards. So at this point, I think, what the market seems to be saying is that it might grind sideways or grind upwards a little bit, or just sort of drift, into a little sort of, 38% retracement or something like that. So difficult to find the next direction. We don't really have any earnings out. Geopolitics seems to have, for the time being, sort of calmed down a little bit. So that's just where we are at the moment. So in terms of next direction, let's just look. We had yesterday we had a couple of bond auctions. So we had the 2-year and the 5-year. The 2-year tailed by about a basis point or so it wasn't great. But what was interesting is that the 5 actually was pretty well supported. And if we just have a quick look over at all the different yields, let's go on the yields rather than the thing. We can see here that basically what's happening is that the two is sort of drifting downwards, but not really in a strong way, just because the market, the 2-year yield can't really come down strongly until the Fed gives the all clear for, definitely to say, that we're not going to hike anymore, although that's what the market believes. But more importantly, the sort of the cutting cycle. So the two sort of just slowly, like a feather drifting downwards. But you see, as soon as we go to the 5, a bit of a stronger direction down, and then in the 10s, and then the 30s, as you see here, pushing downwards. So of course, there could be a little bit of resistance. Let's just go to the 10 at this 4.3 kind of mark here. That's going to be a pretty important level here. But at this point, the general sort of consensus seems to be that the Fed is done. And we just have to figure out, how long they're going to keep rates at this level. So maybe, we can look at that and just look at the SOFR contracts here. So this is the SOFR curve in terms of implied yields, which of course the SOFR is the overnight financing rate, the 3-month one. And what we can see here, I'll just bring in the zoom a little bit. We can see that, effectively, the market's saying, hey, the Fed's going to sort of hold for, a few months. And then at some point, they're just going to cut sort of regularly. But what's quite interesting is to actually look, let's say, this is the curve as we speak, on the end of November. But if we go back 1 month, we can see just how much that has changed. So if we look at going back 1 month, you can see here that all across the curve, but especially out into 2024 and 2025, the curve has moved down a lot lower. So the market has essentially, I don't know if it's moved it's moved the cuts forward just a little bit, but it's also moved them down quite a bit. So what's happening here is that the market is essentially saying, there's no more cuts. You see 0 here for December, 2 basis points, and then we start seeing negative signs. So at this point, the market is basically saying that somewhere between sort of May and June, there's going to be, the first cut. So what does that mean? That's going to be what could change that. I mean, what could change it to the upside would have to be a series of extremely resilient economic data, very strong Actually, I'd say not just resilient, but strong data, much higher than expected data. We'd have to see inflation actually sort of going upwards again. And of course, maybe very hawkish rhetoric from the Fed. We would also probably have to see at the upcoming December meeting in about 2 weeks, we'd have to see some kind of maybe a revision to the summary of economic projections if the Fed really wants to give a message. But at that point, they don't particularly they seem to be, relatively happy with the way things are going. And that's that. So just in terms of what we're going to get today, though, what is interesting is that we are going to start to get a barrage of speakers. And keep in mind that this Friday is going to be the blackout period. So the Fed members will no longer be sort of speaking here. So we've got a few people today. We have Goolsbee at 10 o'clock. I think that's just opening remarks. Waller, that might be more interesting at 10 o'clock. Bowman, that's probably it. So I'd say maybe the Waller one is going to be the most interesting at 10. It's something to be sort of thinking about then. And then, of course, we do get the Beige Book tomorrow. And keep in mind that the Beige Book is sort of just anecdotal evidence from the different sort of Fed districts sort of saying how things are going. So that could give a sense of whether it seems like the economy is sharply slowing down or just sort of, fairly resilient. And then, of course, probably the most important thing here to look out for, of course, is going to be Jerome Powell on the 1st of December, which is Friday, speaks in a fireside chat. Hopefully he's might be roasting some marshmallows or something like that. Anyway, so we have Powell a couple of times on Friday. So definitely that's probably going to get the market's attention. And then just in terms of the data, today we get a little bit, because yesterday we had sort of slightly weak housing data, new home sales, I think it was, and that just pushed down the yields a little bit more. And so this whole narrative that, the economy is, doing okay, but is sort of slowly, softly landing the juggernaut is the issue. And what's going to be maybe going to get a little bit more attention than normal today, we have the consumer confidence, the conference board consumer confidence coming up at 10 o'clock, present situations, expectations. So that for me has always been a very second tier or maybe even third tier kind of data point. But in the absence of other data points and in looking for directionality, maybe the market wants to react to that today. And basically the idea is that the 100 is sort of a, pretty important sort of psychological level. So let's just see if that, if the confidence level stays sort of robust or whether it decides, excuse me, I'll just have a bit of tea here, or whether the consumer confidence level goes below the 100. That would maybe be a bit of a psychological level here. We have a couple of other tier 2 sort of data points here. We have the Richmond Fed, which is also reporting at 10 o'clock. So we do have a couple of, sort of a smidgen of data here just to maybe sort of give a bit of directionality. But apart from that, not a lot. We do have the auction, the 7-year auction at 1 p.m. As I say, yesterday, the 5-year auction went quite well. The 7-year might be a little bit more important. And the market feels, to me, just a tad complacent at the moment. Seems to be sort of very happy with everything. As I said, if we just look at the equities, they're just, just sort of drifting around. We look at the yields just drifting downwards. I mean, what is kind of interesting, though, gold doing pretty well. And we have a sort of a slightly softer US dollar. We have yields drifting down. We have real yields drifting down. We have financial conditions sort of easy. So a lot of these, well, not so much financial conditions, but a lot of these other things are supportive for gold. And if we look at some kind of Fibonacci measured move, the idea here is that gold, at least from a technical perspective, could quite happily, if it gets through this level here, where it's at currently, could quite happily retest the highs and maybe even a bit further. So the gold bugs are getting a bit excited about that. I just wonder whether is that going to be too easy that it bursts through? Can you be shorting here on a softer US dollar and lower yields? I mean, let's put it this way. If we do get a little bit of hawkish sort of Fed speak, especially from Powell and maybe a couple of the others, maybe we get consumer confidence holding up, maybe we get a GDP print later in the week and ISM stronger than expected. This would be a nice place for gold just to have a retrace. On the other hand, anything soft, for sure, this is, once it gets through here, you've got to say that there's quite a lot of upside for gold. So gold at kind of an interesting level there. Other thing which I'm just keeping an eye on is just the yield curves. A lot of people have been talking about steepness and whatnot. As you guys can see here, let's say the 2s, 30s. I mean, a tiny bit of green here, but essentially this actually has been flattening and sort of flat, if anything, over the last few days. So not a lot of price action there. If we look at the 2s, 10s, again, pretty flat. So I don't think there's any enormous urgency to get in on this trade. That's my personal view. I think it's going to be there's going to be plenty of action happening next year. And if anything, it could just sort of drift down a little bit as if we continue to see these long end yields being supported. And we might get a little bit of a kick today. As I say, we do have the 7-year yield, which has a little bit of duration in the 7-year. If that is, shows weak sort of interest by the market, that could cause a little bit of bear steepening at the margin. We'll keep an eye out for that. Apart from that, we did just interesting to look at the dollar index here, which of course is a lot composed of, is very Eurocentric. Getting to an interesting level here in the Dixie around about the 10, let's call it 103 mark there. There's a little bit of sort of vertical resistance there. I mean, could this keep on drifting lower? Yes, it could, but at the end of the day, I mean, I think it's maybe even more instructive to look over the euro, which is about 57% of the dollar index here. The euro's had a big run upwards, as you guys can see here. We're getting to sort of an interesting 61.8 fib retracement level coming up pretty soon. We also, this horizontal gray line here goes back a while and is, quite an interesting level. So could that start to run out of steam? I mean, we can look at a few, it's well above all the moving averages. We can look at the Bollinger Bands. It's not particularly bursting in the top of the Bollinger Bands. So still quite strong and not, necessarily massively overbought. But at this point, you've got to say, what are the fundamentals here? It's not exactly like the European economy is outperforming the US. It's not really the fact that the European Central Bank is more hawkish than the US. And in fact, yesterday we had a speech by Lagarde in front of the European Parliament, essentially saying that inflation was coming down nicely. The Eurozone economy was, a little bit sort of fragile. And so not exactly dovish. And if we actually just look at the sort of the pricing, it's more or less the same at this point. If you look at the pricing of the ECB cuts compared to the sort of the Fed, we can see that they're essentially the same. We see, looking at the Fed here, we've got a terminal rate here of about, let's call it 535, going down to it's about 85 or 90 basis points. And if we look over here at the Eurozone, you can see that the terminal rate is about 3.9, and by the end of the year, going down to about 3.25, so about 75, 80 basis points as well, slightly less. But essentially, the ECB is just as dovish, and the market is pricing it just as dovishly as the Fed. So you've got to say, why is the euro outperforming here? And I don't think that this is really sustainable. A lot of people are talking about this nice round number, the 110, which is getting soon. So I think anywhere around here, you've got to say that there could be significant resistance for the euro. The other thing which is kind of interesting, just talking about, the Eurozone, Lagarde yesterday referred to the PEPP, the Pandemic Emergency Purchasing Program, which essentially was brought in during the COVID period in 2020. Which is a kind of quantitative easing, which sort of disproportionately benefits some of those peripheral European peripheral in terms of bond markets, of course, like Greece and Spain, and particularly Italy. And Lagarde yesterday, which is the first time she's really spoken about this, to my knowledge, was basically saying that was something they should start to talk about. And so obviously behind the scenes, some of the more hawkish members of the governing council, they're really starting to push for a bit of a roll-off of the balance sheet, so a bit of quantitative tightening, which at the end of the day, that could be a little bit supportive for the euro, and it could be a little bit negative for, let's say, for example, the Italian bonds and stuff. So if we start looking here, we can look at something like the yield here, the BTP spread over the German one, and that's starting just to tick up a little bit. Interesting. Just to start looking at that there, that's come off quite a lot since the last ECB meeting, as you can see. So that's something to keep an eye on. And if it gets down to 170, interesting if they start talking about the PEPP. And if you start looking at the Italian yields here, starting to go up a little bit. And that's interesting there to look at that. The other thing, of course, a lot of people, we have the OPEC Plus meeting on Thursday. Not really a lot happening in the market, just in sideways here, waiting for that. It's a very tricky one for OPEC because at this point, the market believes they need to do something to maintain some more cuts to maintain choices. What seems to be happening is that behind the scenes, the Saudis seem to be twisting the arm of some, like the Angolans and the Nigerians, to maybe sort of cut a little bit more. Maybe there's going to be some kind of compromise, but I think the market's going to be underwhelmed by that, because there's a sense that demand is sort of softening. There's a sense that inventories are building. There's a sense that supply is still outstripping demand. And we can see that if we look at the curves, we can see that the front of the curves for both Brent and WTI are in a bit of a contango. And so I think the market, in order to push high here, will need a significant sort of positive surprise from OPEC Plus, which, to be honest, I'm not sure how they're going to deliver that unless they do something a little unexpected. I was about to say crazy, and the Saudis decide to sort of unilaterally increase the cuts to 2 million barrels a day or something like that. So I think at best here they might just sort of extend the cuts, try and get another 100,000 or 200,000 barrel cuts from a couple of the smaller members. But I think the market's going to be underwhelmed, and I can see oil maybe even sort of not even drifting down, but coming down quite hard and maybe sort of wanting to retest down here. We shall see. So that could be a very interesting meeting on Thursday. So that's it, guys. I think apart from that, that's about it for today. As I say, we have the consumer confidence. I'll be looking out for the speech of, what was it, Waller, I think at 10 o'clock. Let me just check that, because if that's at 10 o'clock, that's the same time as consumer confidence. So that could, just give a little bit of excitement here. Yes, we have Waller at 10 o'clock, and we have the conference board, consumer confidence. So around about 10 o'clock, there could be just enough to sort of get the heart beating a little bit. Okay, so I'll leave it there, guys. We'll keep on talking. As I say, things start picking up a little more on Thursday and Friday. We'll see how we go then. Okay, take care. We'll be back in touch. Thank you.